Hello guys, right now we're in the Thinkorswim window, and while the markets are still open, I want to show you guys how the EMA and the SMA works so you guys can implement this into your investing and your trading. So in as short time as possible, in like just a few minutes, you're going to learn about what the exponential moving average is and what the simple moving average is. So right now we're in Thinkorswim, or TD Ameritrade's trading platform. We're going to go to add study, moving averages. And the first moving average we're going to take a look at is the SMA, or the simple moving average. So for those of you guys that are like learning about lines of best fit, this is really what an SMA is. All it does is just take, let's zoom in here, it just takes two data points and divides them by each other to create this kind of line of best fit. And that's really what the SMA does. Now, a more valuable type, this is used for you to track the trend of a stock, but a more valuable type of moving average that builds off of the SMA is the EMA. So remember, SMA is the line of best fit. This will be important later. So notice how here, this is the Vanguard Total Stock Market ETF, or VTI. Here, despite the stock prices going down, straight down because of this coronavirus, what's happening here is that the SMA is actually just slightly, it's going not as quickly down, and it doesn't have that much of a downward slope as the current data points here. So you should keep this in mind when we look at the EMA. So here we're going to go to add studies, moving averages, and adaptive EMA. Now I know both of them are blue, so I'm just going to edit that real quick. Nice. So the red line, this is the EMA, adaptive or exponential moving average, and this is the SMA, or the simple moving average. I'm going to zoom out here. Now remember how I told you guys to pay attention to the data points, which is like this green and this red? Well, look here, this is the blue SMA, and we can see that it's not as much of a downward slope. However, this red line, let's zoom in over here, this red line tends to follow these data points, or like these little box spots of green and red. This red line, which is the adaptive EMA, tends to follow these data points more closely, or more on the dot, than the SMA. Now the reason that, because of this whole coronavirus, the reason that the EMA dropped more than the SMA is because, or had more of a downward slope, is because the EMA tends to place a higher weight on the more recent data points. So basically, when it saw that the stock price dropped, it would drop more than the SMA, because the EMA knows whenever a stock price goes up or down, I should follow that more closely than past points. That's really just saying that it's more likely, or it's going to track the newer data points more to the dot than the SMA. So here, let's look here. Here we can see, oh, I don't want it that large. Here we can see that the stock price of VTI is appreciating, right? Well, if you look really closely, you can see the EMA is going closer to the stock prices similarly than the SMA, because the SMA is just a simple line of best fit, whereas the EMA always tries to go closer to the current data points. So when the stock price is going up, the EMA will go at a higher upward slope than the SMA, and when the stock price is going down, exact same vice versa, as we saw here. When the stock price is going down, the EMA will also go down at a more downward slope than the SMA. Now the reason you would want to use an EMA instead of an SMA is because an EMA can tell you how over or undervalued a stock is. So here, I'm going to zoom out. Here we can see that the data points, or these green and red things, they're above this red EMA line, right? And because they're above the exponential moving average, that lets you know that they're usually going to be overvalued. However, if they're under the red lines, that lets you know it's going to be undervalued. If it's over, it's overvalued. Under, it's undervalued. Now this can be just another method of validation when you're trading or investing, for you to say, hey, I like this stock because it's undervalued, or I don't want to buy this stock because it's overvalued. That's really how EMAs can really help you, and moving averages can help you decide whether or not you want to buy the stock. Because always remember, you want to buy the stock when it's at its lowest price, or you want to buy low and sell high. So you want to buy undervalued stocks like here, wait for them to appreciate, and then sell them off. Don't ever try to buy overvalued stocks and then sell them off when they get low. That results in you having a loss. So yeah, that's EMAs and SMAs. Summarize: SMA, simple line of best fit. EMA, exponential moving average, tracks the data points, the most current data points, and tends to be on the dot with the data points, because it puts a higher weightage or in other words, it's just more on the dot, and it has more of a refined and accurate slope than the SMA. So yeah, thank you.